Hi everyone, and welcome back to another exciting installment of Finance for Managerial Decision Making. This is Professor Watts, and today we're going to talk about risk and return, two fundamentally important concepts in finance. Let's get started. Now, when we talk about risk, we need to actually delve into some economic categories here and understanding the difference between risk and uncertainty. They actually don't mean the same thing. Here's a concept. It's what are the chances of a bad event happening? That's what risk means. Whereas uncertainty is the idea that there's bad possible events out there, but we might not really even know about them. We might not be aware of them. And when they happen, they surprise us, hence the term uncertainty. So there's a fundamental difference there between risk and uncertainty. If you're playing roulette, there's a chance that the ball will land on any given number or either color, red or black. That's risk. So if you bet on black, you're facing a risk of 50% that the ball will land on red. When military unit goes into combat, they might not know where enemy soldiers are stationed, and they get surprise fire. They go into a minefield by surprise. Those kind of things are uncertain. Okay, so as I mentioned, with risk we can apply probabilities. Known to greater or lesser degree, certain things are known really well based on observations and data that's been collected over time. Here's some examples. The chance of a late frost. Farmers might be concerned about this. If you're getting ready to plant, you want to make sure you're past frost. If you're a bank, you're interested in risk of default. We'll perhaps estimate, when we don't have a whole lot of experience data, what's the risk of recession? Well, we don't know, but we can model it, and different people will have different ideas about what the most important factors to include in models is. Okay, with uncertainty, there's no experience, there's no models and forecasts available to calculate and predict, and so we can't really come up with numbers here. Events may be unforeseeable. Who knows what the next great innovation is going to be, the next discovery, the next natural disaster, the next where the next terrorist attack will be, that kind of thing. So, by definition, kind of unknowable, unforeseeable, and that's what makes uncertainty so difficult. There's a famous comment about this from former Secretary of Defense Rumsfeld.
There are reports that there is no evidence of a direct link between Baghdad and some of these terrorist organizations.
There are known knowns. There are things we know we know. We also know there are known unknowns. That is to say, we know there are some things we do not know. But there are also unknown unknowns. The ones we don't know, we don't know.
Okay, now when we're doing calculations and models, we got to have some numbers to work with. This is finance after all. So we treat possible events as risks. So we have a probability. Now, we'll be more or less confident in our numbers that we use, but nonetheless we treat things as risks, so we can apply probabilities, and that way we can do some meaningful math and develop some things like expected values and then try to assess risks numerically. So we're interested in finance in concepts such as expected return on an investment. And when I say an investment, I could be talking about going and buying shares of stock, or within a company talking about launching a new product, building a new facility, purchasing new equipment, hiring new workers, etc. When we discuss expected return, we're going to use concepts of weighted average, and then probability distributions. We'll work with concept of standard deviation, sigma, which you might be familiar with from statistics. It's talking about the average dispersion of possible values, possible outcomes, and then the coefficient of variation, which is just a way to kind of normalize the standard deviation across different scales of measurement. Okay, so probability distribution. You probably remember, I hope you remember from statistics, or you're familiar with this just from your past experience, the idea of a bell curve. This is a normal distribution, and we're talking about the probability of various outcomes, and particularly we're interested in the return on an investment. So let's model that here, and right in the middle is the mean. Greek letter mu stands for mean, which is the average return for all possible states of the world, all possible outcomes. And let's say for this particular investment, the average return is 10%. Okay, so that's right at the middle of all the different possibilities. Now, there's some really good years, and we get outlier out here where the return is 30%, and there's some really bad years. Down here, the return is minus 20%, for instance. And then there's everything in between. Now, what the shape of the distribution means is that more of the possible outcomes, the area under the curve represents probabilities, so more of the possible outcomes are clustered towards the middle, so it's much more likely you're going to get 9% or 11% in any given year than the worst case outcome of minus 20 or the best case of plus 30. Okay. And then a normal distribution, which has this symmetrical shape, is defined by what we call the empirical rules of its standard deviation parameter. So let me review that really quick. So if we go out here to one standard deviation, and I'll review standard deviation in a little bit more detail in a minute, but you can just think of this as the average dispersion of values. So the farther apart the values are, if the maximum were 50% and the minimum were minus 40%, it would have more dispersion, and so it would have a higher standard deviation. A really narrow distribution like this, where the average is 10, and then the maximum is 12, and the minimum is 8. And you never see anything less than that or greater than this, and most things are clustered right around 10. Well, that's going to have a low standard deviation, doesn't have much dispersion. And then one with a lot more dispersion like this, where the average is 10 and the max is 100 and the minimum is, let's say, minus 90, and you have a lot of possible options in between there. That one's going to have a high sigma, higher dispersion. Okay, so sigma, dispersion, right? The empirical rules of our normal distribution state what percent of possible outcomes occur within each range in terms of sigma. So we go plus 1 sigma, minus 1 sigma here. That represents 67% of all possible outcomes. So the way we write that is like this: plus and minus 1 sigma. That's going to be about 67% of all occurrences. We go out another 2 sigma. That's going to encompass 95.5% of all occurrences. And then if we go all the way up to plus and minus 3 sigma, that's going to encompass 99.7% of all occurrences. Typically we say anything outside of plus and minus 2 sigma is rare. We call that an outlier. Okay, now that brings us to the idea of expected return calculation. Expected return says, well, there's different states of the world. Okay, back to my normal distribution, there's a bad state of the world with a really low return of minus 20. There's a really nice state of the world with a return of positive 30. Then there's a whole lot of things in between. Well, what's my expected return if I average out basically all those different expected states of the world? Now, of course, the 30% is not going to play in very large, because that only occurs a very small fraction of the time. Same with the minus 20. Whereas my 9 or 11 or 10% occurs much more frequently here. You can see the height of the distribution at these values is much higher. So those are going to play in much larger. Well, my average, I know of my normal distribution, my average is the value right in the middle. So my expected return here is known as 10%. If I didn't know it, I would just look right to the middle of the distribution. When we don't have such a perfectly normal distribution here, we might only have a few discrete points, such as I know a probability of 0 is going to occur, let's say 10% of the time, and a return of 5% is going to occur another 20% of the time, and a return of 10% is going to occur 50% of the time. So let's say this is the probability distribution I'm working with. It's a discrete, it's not a normal distribution, it's not a continuous distribution. So if I'm working with something like this, that's where I want to use this concept of the expected return calculation. So here's an example. We're evaluating Zumwalt Corporation's common stock, and we estimate the following returns giving different states of the economy. Here's those 4 different states of the world I was talking about. So we've got a downturn, possibility of downturn, and that's a 10% probability, 0.1, just the decimal version of 10%. A zero growth situation, 20% likelihood of that. A moderate growth, 40% likelihood of that. And a high growth, that's maybe like 1 to 2% economic growth. This is 3% plus economic growth. And we got a 30%. So here's our probabilities, and then here's our expected returns. Now, to calculate the expected return across all 4 of these different states is pretty easy. It's just the weighted average of these returns. How do we calculate that? We just multiply them. So the 10% times the minus 5% equals minus 0.5%. 20% times 5% equals 1%. 40% times 10% equals 4%. 30% times 20% equals 6%, and then we add them up. The weighted average of probabilities like this is the sum of the products. And actually, when we do this in Excel, we can use a function called sum product, which is pretty convenient. So add those up, and K here is just the symbol for the expected return. I think they give us the equation for that here. Yeah, so K. Now that looks like intimidating math, doesn't it? But it's really not that complicated. Expected return equals the sum for all of your different states, for all n of your states. In this case, we had 4. 1, 2, 3, 4 outcomes. For each outcome k, it's a probability of that k. That's what this whole thing means here. Times the expected value for that k, for that state. So that just in math what we did here. Okay, now let's move on and talk more about the standard deviation. Okay, remember, standard deviation measures the average dispersion of possible values within a distribution. And this is the formula we're going to use when we have probability situations. You might remember from statistics, when you're dealing with just a set of values, just a set of quantities, a set of measurements, that's your regular standard deviation formula for values. But when we're dealing with probabilities, it's a little bit different. And again, when we do this, we'll do it in Excel, and we'll have it kind of set up according to a template, so that'll make it easy for us. But that's how we're going to deal with standard deviation when we're talking about discrete probability distribution. Okay, now the coefficient of variation, it just takes the standard deviation as a percent of the mean. Standard deviation divided by mean is the formula. Mean is also sometimes referred to as expected value. And the reason we use the coefficient of variation instead of just the standard deviations is because this scales the standard deviation up or down according to the magnitude of the underlying values. Okay, now the book has a pretty nice example of two companies that are called Com and Bold, and they have unique distributions of possible sales, and then we can use those distributions and some other assumptions about the probabilities of each outcome to examine these concepts in practice and then talk a little bit more about risks. So I've replicated this in Excel, and let's jump over and take a look. Now the first thing is the distribution of sales for the two companies, and we're again thinking in kind of terms of probability distribution, but this time it's discrete. It's not the continuous, the bell curve, like in that normal distribution example. And how we want to read this is the mean is it is a symmetrical distribution, so the mean is the middle. So the $1,000 of sales is going to occur 70% of the time, and then 800 is going to occur 10%, 600 is going to occur 5%, 1200 is going to occur 10%, 1400 is going to occur 5%. So this is a really narrow distribution of possible outcomes, and that means it's going to have a relatively small standard deviation as compared to company Bold down here, which has a much flatter and much more spread out distribution. So its middle is still 1,000, so its mean is still going to be 1,000, its expected value, but that's only going to occur about 22% of the time, and then it's going to have 800 occurring with a certain percentage, 600, and diminishing percentage of each occurrence as we go down in values, and the same thing as we go up in values. And the way I calculated that, just to show you, is I have the possible outcome here, and then the probability of each outcome, and then the expected value of the mean. I did that as a sum. I actually individually calculated the expected value of each outcome, which is just the amount times the probability, and then I just add those up here. That's what this cell's doing. I could just as easily do that with a sum product, and let me show you how this works. In sum product, you select an array, and actually because there's 0 probabilities here, I don't want to take those values, I only want to take the ones that have positive probabilities, and then you multiply it by another array, and notice that gives me the same result, $1,000. So that's my expected value. It's this array times this array, or the sum of this times this, this times this, this times this. And then my sigma, now that's a little more complicated process. What I have to do is take the probability of the difference between each observation and the mean down here, and then sum all those up, and that's what I'm doing right here. So my sigma, my standard deviation for company Calm, which remember was the much more narrow range of outcomes, is 155. And then when I go down to company Bold, I'm doing the same math for both of those, and we see it has a much higher standard deviation of 385. Now the issue that comes into play is, what if company Bold were a larger company and all these values were 10 times larger? So its expected value of the mean here would be 10,000 instead of 1,000, and then the sigma would be 3,850, and that's not really comparable to the much smaller sigma of the first company. So when we're dealing with that, what we want to do is calculate that CV, the coefficient of variation. So the coefficient of variation is just equal to the sigma divided by the mean, and we're going to get a value of and that's in terms of percent now, so I want to show that as a percent in Excel. And then same thing for here, equals the sigma divided by the mean, and also show that as percent. Okay, now the book works us through a couple other aspects of this problem, and I think they're worth looking at in a little more detail. First off is what happens when we look at not just sales. Okay, before we're looking at sales, these values here, but we want to look at the net earnings. And here we're looking at EBIT, earnings before interest and taxes. It all depends on the way our costs are structured. So the first thing we're going to assume is that we're dealing with strictly variable costs. And what that means is that costs rise constantly with sales. And if we have no sales, we have no costs if we're strictly dealing with variable costs. To arrive at our EBIT, earnings before interest and taxes, we just take the sales minus the variable costs. Okay, so now this is the distribution of possible outcomes we're interested in. We still have these probabilities for them, so we can calculate the mean. Notice here I'm just using the sum product formula. And we can calculate the standard deviation. Here, instead of doing the math in columns, I'm just doing it all in one big Excel function. And then I'm taking the coefficient of variation. Now, same coefficient of variation, you'll notice, different mean, different sigma, because we're not dealing with just sales. Now we're dealing with net income. Here's company bold. Same data, sales outcome, and the probabilities of each outcome. Different variable cost structure. We plugged that in, and then we calculated the EBIT. And we see that the mean is the same, so just like it was with sales, but the sigma is larger and the coefficient of variation is larger. And these values match what we accomplished here with just the raw distribution of total sales. What we want to do is compare when you only have variable costs to a situation where you have fixed costs. That's what we're doing here. And notice now, instead of a variable cost which rises steadily with the sales volume, now we have a fixed cost which is the same regardless of our sales volume. And indeed, that puts us into a loss situation at these lower sales levels because the sales doesn't cover the fixed cost. But it puts us into a higher profit with these higher sales volumes because the fixed cost is fixed and it doesn't keep rising with the volume of sales. So what is that going to do? Well, we have a wider distribution of possible net incomes. We're going to have a equal expected value because it's still symmetrical, but we're going to have a much higher standard deviation. Notice that that's now 154. It was 21. So we have an explosion of the standard deviation and a corresponding explosion of the coefficient of variation. So the rule is that if you have fixed costs rather than variable costs, you're going to have a more risky distribution, a more spread out distribution, more possibility of losses, and you can see that reflected in the tremendously larger standard deviation and coefficient of variation. The same phenomenon will apply to company bold, where we have the same fixed costs level across all possible different sales outcomes, and the mean is the same, but we see the sigma is much larger. It used to be 53, now it's 384, and then the coefficient of variation has exploded to 275%. It used to only be 38%. So fixed costs make your dispersion larger, the riskiness of your income or profits larger. Okay, so there's a little more nuanced understanding of the different components of risk within a company. Depends on the cost structure. And higher fixed costs bring you higher risk in terms of either the standard deviation or the coefficient of variation. And then the degree of debt financing, again, debt is just is a fixed cost. So of course with higher debt we have higher fixed costs and more risk. Okay, now wrapping up here, I want to cover just a few more concepts. Risk is the potential for unexpected events to occur. If two financial alternatives are similar except for their risk, most people are going to choose the less risky one because they're risk averse. They don't like risk. In fact, risk averse doesn't just mean that you view risk unfavorably. It means that you'll take steps to avoid risk, and you'll even accept a lower payment if it involves less risk. This gives rise to a really important principle, which I'm sure you're probably aware of already. We just want to formalize it. Risk averse investors require higher expected return as compensation for taking on higher risk. I'll label this a fundamental financial principle, the positive relationship between risk and return. In other words, riskier assets / investments must offer higher returns because pretty much all of us are risk averse, and in order to get me to take on more risk, you're going to have to compensate me or incentivize me with a higher expected return. And here's an example. We usually use T-bills, government bonds, as the example of the risk-free rate of return. Now, it's not really 6%. We're talking about 10-year Treasury notes. Let's maybe update this to fall 2017, maybe about 2.3%. Would be the expected, the current yield on 10-year Treasury notes. There's no risk in that, at least in terms of getting your principal back, because as we all know, Uncle Sam has a little buddy called the Federal Reserve, and the Federal Reserve can print money to help Uncle Sam pay off his debts if he needs to. If you don't believe me on that, just listen to former Federal Reserve Chairman Alan Greenspan.
The United States can pay any debt it has because we can always print money to do that. So there is zero probability of default.
Okay, so here we're looking at our hypothetical stock of Zumwalt Corporation, and notice that the difference here is that there's a distribution of possible outcomes. We've indicated 3 states of the world and the corresponding rates of return. And in reality, there's probably more than 3 states of the world. This is just a summary. So we have a bad economy, it only returns 5%. A moderate economy, it returns 10%. And a booming economy, it returns 20%. And then, of course, we could calculate the expected value by multiplying the probability, which is over here, times the expected rate of return, and then adding those up. We could do our weighted average method, which we'll do more of that in Excel in the homework problems. And we know that that is going to be somewhere, in here probably it's going to be somewhere closer to 10%, because the risk of this, and notice in the worst state, this does worse than the Treasury bond, well, at least in the initial example. Let's say in the worst state of, in a worse state of the actual economy, what do stocks do? They go negative. We go into a bear market. So in the worst case, stocks do minus 10%, and Treasury bonds, that yield might fall a little bit because of flight to safety, but it might only fall to like 1.5%. So you're still going to preserve your capital with the T-bills, whereas you're going to lose it with the stocks. So the higher riskiness, the higher spread of possible returns here, and the inclusion of negative values, means that average, the expected value of the return here, is going to have to be higher. The nominal expected return on stocks is probably going to be something like 12%. Okay, and then furthermore, on that concept of risk of a company and investing in a particular company, we can separate it into 2 aspects: firm specific and then market related. Firm specific, as the name implies, is strictly due to factors within the firm, and then market risk is due to overall market conditions. That's basically macroeconomic conditions. Is the economy booming? Is the economy in recession? When the economy is in recession, which stocks are going to decline in value? Yeah, pretty much all of them. And when the economy is booming, sometimes, to a greater or lesser extent, all stocks might rise in value. If Zumwalt Corporation has some kind of failure or scandal or recall, its stock might take a huge hit, but that's not going to affect any other businesses because they're not correlated with Zumwalt. So, for example, the book says the stock price will fall if the major government contract is discontinued, but that only affects that one company, therefore that's firm-specific risk. For market-related risk, if the overall market is doing well, booming economy, prospect of tax cuts or something like that, all stocks will rise, including this one, so that's market-related risk. And this leads us to the concept of diversification. How do you get rid of firm-specific risk? Well, you buy a lot of different firms, and then negative risk of one firm will probably be canceled out by positive outcomes with other firms. So you can actually get rid of firm-specific risk just by diversification, holding stock in many companies. And when we say many, we mean dozens and potentially hundreds. So you hold the whole stock market, there's thousands of companies there. And because you're holding companies that are unrelated, uncorrelated, you can wipe out your firm-specific risk. You can't eliminate market risk because when you diversify, you're kind of by definition holding the market. You're holding a little piece of every company or every security in the market, so you can never eliminate market-related risk, and that's just something we have to be aware of. It's just a fact of life in finance. So this leads us to the second fundamental principle: diversification reduces portfolio risk. In other words, holding multiple unrelated investments reduces the negative impact of any specific risk factor, like company risk for one particular stock issue. Okay, so that'll sum it up for our overview of risk and return. We'll do some homework problems on this, and then moving forward, we're ready to talk about one of the core things in finance, one of my favorite concepts, which is time value of money. See you soon.